In this video, we're going to discuss full cost transfer pricing. So when a company says that it uses full cost transfer pricing, what that means is when there's a transfer within the firm, the price that is charged between divisions is the variable cost of production plus the fixed cost of production. There could also be a markup added to that as well, but let's just focus on the base case here. We've got the variable cost and the fixed cost. So, and that can lead to issues, and I want to show you why with this example. Let's say we've got a company called Self-Driving Bicycles, and they build and sell bicycles to retailers, and they've got a couple departments. They've got a seat department that manufactures bicycle seats, and then they have a bicycle department that manufactures bicycles. So the bicycle department could hypothetically get seats from the seat department. They could have an internal transfer, or the bicycle department could get seats from some company outside the firm. Okay, they could pay $38 to some company outside the firm and get the seats elsewhere, and then the seat department could sell elsewhere as well. They could sell to somebody else other than the bicycle department. Now let's say that the seat department could make a maximum of 15,000 seats this period, but they could only sell 10,000 to outside customers. And the price they charge would be $40, but they can't sell all 15,000. There'd be 5,000 left over. So the bicycle department wants to buy 5,000, so it seemed like there's a potential for a transfer here. They're going to have 5,000 extra seats. They want 5,000 seats, so there's a potential for a deal. So let's look at the prices and see if there could be an acceptable transfer price. Well, the variable cost per unit is $22 for a seat department, and the bicycle department is willing to pay $38 to an outside company. So it seemed like, okay, well, there could be some price here potentially where there's a transfer, but we're using full cost transfer pricing. So the seat department is not going to be happy to take $22 because with full cost, they have to get $39. They want at least $39 because the full cost is going to be these two added together. Okay, so the full cost is $39. That's the full cost here. There's no markup. It's just the variable plus the fixed cost per unit is $39. So if that's what should be the transfer, is the bicycle department going to go for $39? Well, no, they're only willing to pay up to $38. They're only willing to pay up to $38 because that they can get from this company for $38. So why would they pay $39 to get it from the seat department? So they say no. So they end up going and buying from this outside supplier. That's what the bicycle department does. And then the seat department, well, there was 5,000 seats that they could have sold. They would, if you think about it, variable cost per unit. So every time they made a seat, it was $22. The fixed costs are going to occur whether or not they produce 15,000, 10,000, doesn't matter. They're going to have the same amount of fixed costs. So really, for 20, they would have been happy in theory to take at least $22 a seat. If let's say there had been a price of $25, then they would have got $3 more than their variable cost per unit. So they made $3 profit, the seat department, per bicycle seat for those 5,000 seats that they would have transferred to the bicycle department. And then the bicycle department would have said, well, now we're not paying $38, we're paying $35. So they would have been happy. So there could have been a transfer here between these departments that is mutually advantageous because there's excess capacity. There's 15,000 seats could be made, but they can only sell 10,000 to outside customers. A deal could have been made here except for the fact that they're using full cost transfer pricing. And so because these fixed costs are coming in, that's distorting what's happening. And actually you end up with the bicycle department paying $38 a seat to some outside supplier when they could have just paid $22 internally, and the firm would have been better off. They're paying an extra $16 a seat here instead of $22, and so the entire firm is worse off as a result.